Don't pay off your mortgage, do this instead. I hear financial gurus like Dave Ramsey saying that the principle of financial freedom is paying off your house. Having a paid off house is nice. There's a lot of other things you could do with that money to help make you more money. In fact, if you pay off your house in full, you could be shortchanging yourself a future opportunity of hundreds of thousands of dollars in the long run. I'm gonna run some numbers. I'm gonna show you what I'm talking about here. Okay guys, so a lot of people are gonna say that I'm crazy on this, and I wanna make a clarification. So I think if you take money from your house and you go invest it in some other things, you've gotta be really careful with what you invested in. My point of view on this is that you should, rather than paying off your house, you should get a line of credit against your house, which means you should pay off the house, get a line of credit against that, or just get a second line of credit against the property and then use that money to invest. But you've got to be very careful what you invest in. So if you have a house and you have some equity in it, you could get a line of credit or a second line of credit against the house that you actually live in. You could then take that money and invest it and get a higher rate of return than what you're paying. Also, as you pay down your house, and you eventually pay off your house, you can increase that line of credit. So then you could have a substantial amount of money that you could then use for investments. Now, for me personally, I don't like to put that money in the stock market. I don't like to gamble with that money. What I like to do is use that money to do hard money loans. And here's the way I think about it. If I take the equity from my property and I do a loan against another property that is, I own that loan, right? There's no loan against it or anything else like that. If something really happened and I happened to lose my property, which would be very unlikely, I would have the other property because I have a loan against that property and I could foreclose and take that property back. So as long as I'm loaning that money against undervalued real estate that I'm very comfortable with owning, that is a great opportunity for me. But if I'm giving that money to somebody else, I'm putting it in somebody else's control, that concerns me. So what I think the best thing to do is what's called trading equity. You take the equity from your house and put 100% of the equity into a different property where you do a loan on that against somebody else that's doing a fix and flip property. They then fix the property up, resell it, you then pay down your line of credit, whether that's a second line of credit or a first line of credit, and then you borrow the money again. Lots of times these lines of credit are prime or LIBOR plus a certain percentage. Right now, most of mine are prime plus 1%, which puts me about 3.5%. Now, I typically loan that money out at 15%. So I'm making a spread or a yield on that at 11.5% for however long that money is out, which turns out to be quite a bit of money because $100,000 at 11.5% is $11,500 of profit after I pay the loan that I have gotten against my property. And so by doing this, I'm able to create an extra $11,000 or $22,000 or $24,000 or more, depending upon how much money I have. So each $100,000 I have, I could make up to $11,500 or maybe more, depending on how I do that. Now, the money's only out and I'm only making money when that money's working, when it's actually in a loan. But the great news about this is I'm only paying interest when I'm using that money. So if I have a line of credit and I'm not using it, it doesn't cost me anything. When I pull the money out, if I'm pulling the money out just to do a hard money loan, then I'm paying interest on that money, but I'm receiving interest from the person I gave that loan to. When that loan pays off, I pay back down my loan, I pay off that interest, and I end up making a profit on the difference. I call this equity swapping, which I think is a very responsible thing to do. Now, other people will tell you don't pay off your house and use that money for something else. I think you should be aggressively trying to pay off your house, but I also think you should be reasonable with the equity that's in there. If you've got equity and you want to invest that into something else, that's a great thing to do while you're still trying to pay off the house. Now, here's the thing. If you made $11,500, you could take that $11,000, pay down the mortgage and continue to get that mortgage paid down, and then you'd have more lending opportunity where you could lend. You've got to do this smart because you need to make sure you're lending against good properties and you need to make sure you're lending to great operators that know what they're doing. These are not high risk loans that you're going to want to be doing. You're going to want to be doing very safe loans because the equity that you're gambling is the equity out of your own primary residence. Now, if somebody tells you to take that money and put it in the stock market or give it to somebody else or do some type of investment, I'd be concerned about that. I've done investments where I've lost all the money that I've put in, even though they seem like sure bets. And there were people that I thought really knew what they were doing that can be very, very problematic. But if you look at giving a loan or a hard money loan, the worst case scenario is that you're gonna have to pay that interest for a period of time when you foreclose on a property or when he does a bankruptcy or something like that. So the worst case scenario in a hard money loan is I'm gonna have to go for a period of time where I may have to pay the taxes on the property, I may not be getting a payment, I'll have to be able to pay the interest payment for however much time that loan's out and foreclose and pay the attorney's fees and then end up getting that property back. So that's kind of the worst case scenario, which doesn't happen that often, but occasionally does. So how do you protect against that? Well, one, you make sure you have enough income so you could pay that line of credit if you weren't receiving money. That's one way that you can do it. If you don't have the income to do that, what you can do is don't borrow all the money. So you can pull out more money to actually make your payments. Now, the banks don't like thinking that you're borrowing money to make your payments. And so the way you do that is you pull the money out, you put it in a separate bank account, and then you make the payments on that, which is a great way to go, which can get you this. So the idea with this is leverage. If I'm leveraging my equity for the equity in another property with a good operator on a property I know is undervalued, that's gonna be a great deal, and I realize that the risk is I may have to go through a foreclosure, but I think that risk is pretty unlikely, then I move forward on that as long as I have the money or I've set aside the money to make those payments. Now, doing this can increase your income substantially, and this is something you can do even if your house isn't paid off yet, and something you should really see. Now, I've seen some crazy returns, and I've even seen people take the money and actually do fix and flip properties where they take the money against their property and they can do a fix and flip or combine that with another hard money loan. So we've seen great returns where people can make even a 300% return or even greater in doing these types of deals. So if you're interested in this, one of the things you're gonna wanna do is how to repeatably find motivated sellers for fix and flips. If you're wanting to do some of these fix and flips or wanting to lend to people that are doing these fix and flips, you're gonna wanna check out this video I put together on how I repeatedly find motivated sellers. There's 4 things that you're gonna learn from it. Number 1, first steps in getting into real estate investing, how to do that, where to go about it. Number 2, you're gonna learn if you can't find sellers, you're not an investor. It's really all about finding sellers. Number 3, I'm gonna show you how I target the right properties and the right owners over and over again. And number 4, I'm gonna show you a simple system to do that. So check out this video now, click over here and you can see it and make it a very profitable day.